The following interview was recorded for PrivateEquity.com radio and the Certified Private Equity Professional CPEP Certificate Program. For more great interviews and other private equity resources, visit PrivateEquity.com.
Today we have with us Lee Duran, a partner and national private equity practice leader at BDO USA. BDO is a professional services firm providing assurance, tax, financial advisory, and consulting services to a wide range of publicly traded and privately held companies. And thank you for joining us, and welcome, Lee.
Well, thank you for having me.
Yeah, well, just to get started, I gave a little bit of an introduction, but I'd be happy to let you, kind of explain your position in your own words. So if you could briefly describe your position now and how you work with private equity firms, that'd be great.
Sure. And my name is Lee Duran, as mentioned. I'm a partner within BDO, and I lead up our national industry practice group for the private equity sector. Mm-hmm. And basically that includes a variety of services for the private equity fund sponsors and the related investments, portfolio companies. So we provide transaction advisory services to private equity funds, provide compliance and consulting services to the fund itself, mm-hmm. and any number of activities to help the fund sponsors manage or basically improve their investments in the portfolio companies. So it's a pretty broad mandate.
Great. Okay, well, it's good to learn a little bit about what you guys do. And I guess just to kind of go into the past a little bit, what was your professional experience prior to BDO? How did you get to this position? Was it through investment banking or a related field or anything like that?
Well, I've been in basically public accounting mm-hmm. for about 30 years now. Okay. And it's always been with a heavy financial services focus. Mm-hmm. Prior to joining BDO almost 15 years ago, I was a partner in a Big Four firm in Japan, okay. and spending my time in the international financial services practice with asset managers, broker-dealers, investment banks, etc. Mm-hmm. And so been involved in the private equity sphere or related industries now for quite a bit of time.
Mm-hmm. Okay, well, great. That gives the audience a little bit of a sense of how you got into this. And I was kind of to switch it up a little bit. I was wondering if I'm sure you've seen this too. There's a broad misunderstanding of private equity by many in the public. There's obviously with the election that kind of feeds into some of the misinformation and confusion about what is private equity. And I was wondering if you could just briefly explain how private equity firms are structured and why this investing model works, or of course in some cases doesn't. And it's just sort of the basic elements of it.
Sure. Just by the very name of the private equity structure, it's really private capital being pooled together to try to identify opportunities for capital gain. And private equity is a very broad definition where it could be anything from investing in real estate through investing with companies with a good idea in the late stage, mm-hmm. Or even more in the venture type, early stage type investing. But really pulling capital, bringing talent that understands the industry and understands the issues that companies are facing from startup through a mature and growth stage, mm-hmm. and being able to help the company on those next stages of life. And so what happens is the private equity professional is able to create value by identifying some of the issues from the company. There could be maybe a misfocus of the market, sure. Maybe a change in the products. It could be, unfortunately, a need to change out some of the senior management, mm-hmm. any number of broad mandates. But they bring a lot of good experience and skills to the table.
Okay. Just one quick follow-up. I noticed you mentioned real estate, and we just had a series of private equity events in New York that we just wrapped up this month, and we noticed a lot of real estate professionals in there. And I was wondering if do you have any insights on how you distinguish between private equity real estate and just real estate in general? You see a lot of real estate funds, and some are sort of marketing themselves as private equity funds investing in real estate, and I didn't know if you had any thoughts on the distinction there, or if you see that trend as well.
Yeah, I think there are funds that come together with specialists, particular in particular industries, and real estate being a focus. But quite frankly, private equity sponsors are looking for opportunities for growth. And if real estate happens to be a good focus, then that may be where the fund is looking. While I was in Japan, there was a very significant downturn in the market, and similar to here in 2008, you found a lot of distressed real estate, and so funds were able to move quickly by deploying some capital and buying up and repackaging distressed properties. And so that fund itself may be real estate focused, but often the sponsors, some of the large funds, have other entities that may do mezzanine lending or direct equity investments with majority control or even minority control. So there's a lot of different types of funds with just different mandates.
Yeah, no, I think that makes sense. And I guess to continue with the focus on trends and what you're seeing out there, what other trends are you seeing in private equity industry today? Is there anything that's particularly caught your eye, or you're seeing a lot of client activity in?
Actually, it's interesting. Is it's a lot of money chasing few really good deals that fit. Obviously, private equity, they're looking for something that is not going to be too long of a play. You need to get your capital back, and generally, they're looking for something between 5 and say 7 years. And so a company that has a good EBITDA or maybe is poised with a strong growth, there's not a lot of opportunities out there that are actually available. So the companies are really needing deal flow.
Yeah, and with that dry powder, you think that's playing into that, of course.
Oh, exactly. The limited partners want their capital. They need it back, and the manager is getting heavy pressure to either return the capital or, quite frankly, deploy it as quick as they can. And so that's why it's important to look at the age of the fund. If they've come in and placed money in 2007, for example, the fund has probably had some difficulty. But if they've raised capital in the last few years, it might be a little bit more patient capital than some of the older stuff.
No, I think that makes sense. That seems to be the story of the last couple of years, is that the dry powder and all the GPs are on the sidelines, hoping to deploy, but sort of waiting for those deals that are coming around. And you've seen some high-profile deals returning, but it definitely has been a difficult slog for a lot of these private equity firms.
No, exactly. You hear in the market, the exciting, the big deals where private equity fund will take Dell privates or from the public market, et cetera. But quite frankly, many of the private equity funds are focused more on the smaller middle market. In the middle market, the deal size is smaller, and so will not utilize as much capital as you see from these big tiered firms. But there's a number of transactions. You'll probably a private equity fund may buy only 3 to 5 companies in a year. So they're really focused upon how to utilize that leverage.
Sure. A few prominent buyout executives have talked about 2013 being the time to sell. Apollo's Leon Black memorably said, "We're selling everything that's not nailed down in our portfolio." What do you take from that? Is this sort of a peak before the trough window for private equity firms looking to sell portfolio companies, or what do you see in there?
I don't know. I've actually got a slightly different take. I imagine, for every seller, there's a buyer, and so there's obviously different positions in the market. And private equity often doesn't necessarily play the economic trends per se. What they're looking for is either value or growth on individual companies. And I do agree that the sales multiples in the last 9 months or so have been fairly good. And so companies are feeling, wow, there's a little bit of exuberance in the air on transactions. And obviously these good companies that have good growth prospects and EBITDA multiples or EBITDA is going to get a good price. And I've seen a little bit of excitement in the healthcare space and in oil and gas, or let's just say energy broadly defined. And so prices, people saying the prices might be a bit high in general, a lot of ask. But I think the private equity guys, you're always looking for that gem among even good high-flying multiples. If you can bring it even higher, then it still might be worth the price. So I don't know if we can say broadly that we should sell everything. I think actually it's just time to be choosy. That's all.
Yeah, no, I think that's the sentiment I'm getting, especially in the middle market. That seems to be what resonating pretty well. Okay, well, I was just gonna go on to, we work with a lot of business owners and wealthy families and entrepreneurs who have started a business, and so I wondered if you could say what you would say to a business owner considering selling to a private equity firm. What maybe they should look out for, what to take into consideration, and just some kind of what you would do if you were in that situation.
Well, and that is really going to depend upon what the particular owner of the business is looking to do. If they're at the end of their work expectations and trying to take the money and retire, that's going to be a different transaction from somebody that wants to grow and is looking for growth capital. Let's say that they're looking for growth capital. You're going to be with these private equity guys for a long time, and you really want to find a firm that you can culturally fit with, guys that you feel that you can work with, talk through issues, because during happy times, of course, it's easy, but there's always going to be issues where you may not meet your forecasts, or maybe there's a particular problem. So you have to be able to feel comfortable with who you're working for. And I think looking for private equity firms that have an expertise in a particular area, if you're in a retail market and you start speaking with somebody that has only the experience in natural resources, that might be a little bit difficult to get the leverage from their experience. So make sure that they've got a good resume in the industry you're working. Make sure they've got a good track record. And I think the top one is just make sure that you can feel comfortable with these people and individuals.
Yeah, I think that's some great advice. It's definitely relationship driven, and you're going to be working with these people for multiple years, and it's important for a lot of these business owners to know that they have someone they can trust on the other side. So I think that's great advice. So I was wondering, I see that you spent a great deal of your career working in Japan. How do you see private equity fitting into the rise of Asian economies? I was in Singapore recently, and have some interest in how these different economies in Asia, Southeast Asia, Japan, how they play into private equity's plans.
Well, actually, I actually think private equity is going to be booming in Asia.
Really?
Up until now, it hadn't been a core focus of capital. Still, it's gone through traditional bank financing or the capital markets, though, from strategic investors. But because of the downturns that you've seen basically from 1997 onwards, it's been about 15 years in total, slowly companies are getting more comfortable dealing with particular individuals. But unlike the United States, where it's a little bit more focused on industry or particular issues, relationships are pretty important in Asia. And so often you've got to work through particular parties or perhaps strategic joint investors into a company or an opportunity that you might see. There's examples of companies coming into Japan and buying up some of the local banks, and quite frankly, they hit the press as that, oh my gosh, here's the barbarians coming in and taking over our banks. And in the United States, I think they're a little bit more understanding about the idea of having to restructure and put a bank back on a solid footing, or any company. But there it was a feeling that outsiders were displacing our workers, et cetera. So I think they have to be a little bit more careful about the long-term prospect and the relationship development.
Okay. Yeah, that's great to get your insights on that. I'm sure we could do a whole interview just on your experience in Asia and your insights on the market there. To continue a little bit on it, I was, as I said, I was recently in Singapore for one of our private equity conferences, and I spoke with a private equity executive there from a firm based in Europe, and he was frustrated by his firm's inability to crack the Asian markets in both fundraising and investing. Are there a few tips that you can offer a private equity executive looking to make inroads in Japan, China, and other Asian economies? I know you spoke a little bit on it being relationship driven, so if there's any other ways that you can kind of make inroads.
And basically come back to the relationships and making sure people understand what the objectives are when you're going in. If it's a really fast objective to basically be able to strip out some assets perhaps and repackage and sell off those assets, it could be a hard sell depending upon the type of industry, because there's a lot of vested interest. The distribution channel in Japan, for example, is very antiquated, and how people develop relationships among that distribution channel has to be worked. If you can come up with something disruptive and work through SoftBank or some of the more recent high flyers, that might be interesting. But if you're working in a traditional industry, there's a lot of relationships that you need to make sure that you're managing when you're investing into those types of companies. So find a counterpart that you can work with, a local, and hook up with them and see if you might be able to do joint investing or find relationships through those counterparts.
Yeah, I think that's definitely true, that last point, because our firm, we have a couple of contacts in Singapore that have been instrumental in us being able to navigate that market, whether it's hosting an event or doing a deal or meeting a family in there. It's just such a huge help to have someone who knows what the situation is on the ground and can sort of represent your brand and make those inroads for you. So I think that's a great point.
Exactly.
And I guess we talked a bit about healthcare being an interesting sector. Private equity will basically chase wherever they think they can get returns from. Are there any particular sectors or investing opportunities that you're seeing private equity firms dive into?
Well, yeah, as mentioned earlier, the private equity is very much focused on the individual company. And so you might be in an industry that's hot, but if you can find even the old Warren Buffett model, basically an old stodgy industry that still continues to have good cash flows. Sure. I'm surprised that companies are still making profit, making and selling cathode ray tubes. There's less competition, so it can create some cash. But if you've got a good product, the hot industries right now is basically healthcare technology, trying to figure out ways to reduce cost in healthcare. And, with the old Affordable Care Act coming up, there's really growth in hot prospects in software. A lot of the oil and gas with regard to just fracking opportunities for basically bringing the tools and models to the particular industries has been kind of a hot area. So it really depends, again, on what you're looking at. I think there's a little bit of a bubble maybe in the social media sectors, because there's just so many companies doing very similar things, and I think it's hard for everybody to make cash flow on these particular products. But that's why I'm not a full private equity investor. I don't see the same opportunities, I guess, that maybe some of these other people do.
Sure. No, I mean, I'm seeing a lot of the same things, especially with the recent IPOs. It's it's easy to have some memories of a not so distant past. Some of the valuations that came out of that. Okay, well, what do you think about the current fundraising environment for private equity funds and going forward? You know, we spoke about dry powder, but you know, we're also seeing some stories of large private equity funds pulling off really impressive capital raising hauls. Do you think that this is going to be the same going forward, or if there's you know, momentum or anything like that?
I actually think you have two broad contradictory plays going on. One is, quite frankly, the yields in other investments. You know, if you're going to put your money into fixed income right now, that's pretty risky, just a CD or et cetera. So there's a lot of money looking for better yield. And private equity has always been a fairly good yield play. Mm-hmm. But at the same time, there's what's called the overhang, and sure, there's a lot of companies out there that have mandates. Let's say pension funds or corporate treasuries that cannot invest more than X percent, let's say 5 to 10% in these alternative investments. And because when they invested a certain amount in 2007, 2008, these went down. And now, as a percentage of total assets, it's too large, and they can't deploy more capital into this. So some funds are finding it very difficult to get new institutional investors. But others are saying it's very good time because there's, especially family offices right now are really looking for opportunities to deploy. So if you can find some family office money that is a little bit more patient, those guys are actually funds that focus on those types of limited partners are raising funds fairly quickly.
Yeah, no, I mean, we're definitely seeing the same on the family office space. You know, as I said, we run the family offices group as well, and we have, you know, a number of ultra wealthy families that we work with. And one thing that I thought might tie this together a little bit is that we just had our conference, and we had not only family offices but also a top insurance company, the head of private equity for a well-known insurance company, had talked about how he was looking for alternatives to sort of the traditional private equity fund. And we're seeing that more and more with, you know, direct investments, co-investment rights, club deals, and, you know, the like. And are you seeing you know, different institutional investors pursuing those avenues and, you know, almost setting up their own private equity shops in-house almost?
Oh, exactly. Family office type stuff where they indeed are. A lot of them are just called fundless sponsors.
Sure.
And that is a fairly heavy growth area. I caution that that's sometimes a little risky because people are investing in areas that they may not be specialists in. So it's always good to hook up with a fund sponsor or a sponsor that has worked in the industry and grown and managed companies through the process instead of trying to start it off on their own because they think of a good idea. As you can appreciate, the private equity funds are not expecting that every investment is going to be a home run, but if they can get at least a good percentage of their investments, that'll work. And if you're trying to deploy it on your own, that takes a lot of capital.
Absolutely.
So it's good to pool capital with some of the others that know.
Yeah, no, I think that's definitely, you know, wise advice. It sort of goes in tandem with that trend. Is that I'm sure you're also going to hear some interesting stories of, you know, when it didn't really go right or didn't meet expectations. So it's definitely good to have some caution attached to that. Okay, well, basically the last question I have, you know, we always try to give some advice to different, you know, private equity professionals, maybe new entrants into the market. You know, we have a lot of participants in our certified private equity professional program that might be listening, and they're looking for an edge in advancing their career. Do you have any tips based on your own career or the careers of your private equity clients that you think would be helpful for somebody who's, you know, looking to work in private equity or looking to, you know, advance their career and, you know, sort of climb the ladder at a private equity firm?
Well, that's a good question, a kind of broad question, but I think, and I've seen really skillful professionals in private equity that have an extremely broad background, anything from accountants, attorneys, technology-focused folks, the good marketing and distribution folks. So it really is kind of working in an area that you're comfortable with and trying to identify opportunities and firms that you trust the others within the firm to build a family around. So again, as we talked a little bit ago, private equity is so broad that there's many different types of sizes of funds. There's fund with sponsors. There's those focused on real estate versus entities or companies that just find an area that is exciting to you because you're going to be spending an awful lot of time. It's a lot of work, and you have to be excited about the looking and exploring and hungry to do this. But I think any background will work as long as you can deploy your skill sets.
Well, great. Yeah, no, I definitely appreciate you taking a swing at that question, even though it is, as you said, a little bit general. But I think those are great insights that people will appreciate. Okay. Well, is there any other topic that you'd like to discuss today, or anything you wanted to cover?
Not particularly. I actually think private equity industry itself is going to continue to grow, and I realize that they've had a little bit of a rough patch with regard to in the political atmosphere, but that capital, pooled private capital, is actually overtaking a lot of the standard indirect investments through banks, and I think it's a good industry to be in, and it certainly is exciting. A little bit up and down, but that's okay. That's part of the nature of capitalism. It's good.
Yeah, no, that's great. Well, I really appreciate your time here, and just for everyone listening along, just wanted to give a thank you to Lee Duran. He's a partner at BDO USA. It's a professional services firm providing insurance, tax, financial advisory, and consulting services to a wide range of publicly traded and privately held companies. And thank you so much for your time, and we appreciate you having you on, Lee.
My pleasure, Taylor. Thank you very much for the call.
Thank you for listening to PrivateEquity.com Radio. If you would like more interviews, visit PrivateEquity.com. At PrivateEquity.com, we offer private equity data, webinars, training programs, networking events, and other valuable resources for private equity professionals.